high five to the team at Bloomberg Economics as well, which had 0.2% on both the core and the headline, and so it is. That's the number. Kathryn, what do you make of it?
Well, it certainly beats the most rosy expectations. Congrats to Anna Wong and her team with regard to, as you mentioned, that precise estimate. This is the lowest in more than 2 years. This is a significant and important deceleration. People are finally in positive territory in terms of real wages. So that's a good thing, and that moves in favor of the soft landing camp, which I've always thought soft landing is the bull case scenario, John. But when you get real wages moving positive, and if they are sustainably positive and significantly positive, then that increases the possibility of a soft landing. Core goods, I think, are important to look at. Shelter costs, of course, are important to look at. These are kind of some of the more stickier measures of inflation. But I would say, on a whole, this is a positive print. I don't think it discards a July rate hike. I think that's certainly going to happen, but it puts either a September or November a second rate hike back in play.
All right. I'm going to try and get some graphics up on the screen in a moment, but just to dig a little bit under the hood. So month on month, as predicted, more or less, you get that used car and truck deflation. So that's down 0.5% month on month. New vehicles end up coming across flat. They were sort of basically flat. The previous 2 months, slight deflation, but here you get a literal zero. Uh, Jonathan, let me kick it back over to you. Could you do me a favor and just sort of tease out why we're seeing such different dynamics between new and used in retail at this point?
Yeah, well, on the new vehicle side, there are definite long-term inflation pressures that are going to remain because you've got substantial increases in the component costs. You've got deglobalization contributing to that. You've got labor costs that are going up substantially, and UAW contract negotiations coming up in a couple of months, potentially making that bigger. But this year, the reason why new vehicle prices should come down and possibly into next year is because we're finally returning to a more normal supply market, which means that we're returning to the old model of discounting. So even though sticker what the manufacturer says the vehicle is worth, or invoice what they charge the dealer is continuing to go up. This year, the declines we are seeing in real transaction prices is because most consumers are no longer paying a premium for it. And that's going to give us more of a deflation trend, probably for the next at least 12 months, possibly 15 months or longer.
Okay. And do you think is it gonna feel as volatile as it's been? Because that's sort of the thing, right? Like we got a sense of this a few months ago towards the end of 2022. Things were feeling better, certainly on the used car front. But then it turned around. Felt very whiplashy from a non-sector expert standpoint.
Yeah, Jonathan, you nailed my exact perspective on this. Basically, demand over the last 3 years for auto has been more than the market could bear. And that's precisely why we've had such tremendous inflation. But as we've started to enter this kind of post-pandemic era, first we started to see the used vehicle prices come down. And like this year has been 3 months of crazy up increases, then 3 months of crazy down turns. But I think we're at a turning point right now where the auto market returns to more balance for the foreseeable future. And that balance market is likely to deliver small and predictable changes in both sales and prices, because we're not really expecting any of this to boost demand significantly. And the market is still relatively constrained, especially on the used vehicle side.
Okay. All right. Well, we know the Fed likes predictability, so that can't be a bad thing. I put up on the screen here, which I'm sort of circling with my cursor. This is a breakdown of the contributions to U.S. headline CPI, and I did it year over year just because it's easier to visualize, even though. Susceptible to base effects and so forth. But you can see how things have have really come in a meaningful fashion. Energy has been the big turnaround. You know, that that services, core services, X food and energy, really continues to be the thing, and in fact, in the past, 6 months has become the dominant thing in those in contributing to those year-on-year numbers. A lot of that, of course, is shelter inflation. Kathryn, I wanted to ask you, given what we know about the trajectory of shelter inflation, given that we know that it's essentially a lagged variable that you can model with a fair degree of predictability based on what's going on inside the Zillow index and things like that. Um, does the Fed increasingly start to look through some of this high and sticky shelter inflation, especially the yeah the rent and owner's equivalent rent component at this point?
To a certain extent, John, but I would say it's such a mighty component of CPI and core PCE that it's really hard to discount it to a great extent. Housing inflation should continue its slow descent. It hasn't moved as quickly as one would expect, given the jump in rates and the surge in pricing, making affordability so difficult. But owner's equivalent rent inflation about 0.5% monthly. Primary rent slowing. That's all good news. What I would also add to this is that inflation expectations. This is going to really anchor inflation expectations. This meaning the very the much weaker inflation print that we saw released today. So that's good for consumer confidence, and in turn, consumer confidence remaining strong and inflation expectations pretty anchored. I think the hard part, John, is going to get service sector inflation down. I mean, this is economy based 2/3 on consumption. The consumer remains robust, John. And on top of that, real wages are positive. That's all good. So to finish here, I think for me, the biggest takeaway here is to get headline inflation from 9.1% to 3% or 4%. That's kind of maybe the easier thing to do, but to get it back to the 2% target from 3 or 4, I think is the more difficult task of the Fed. So whether or not that requires the housing sector to completely roll over, the labor market to collapse, and a recession to occur, I think that's probably being discarded as a probability or a possibility in the markets today. So I would still be wary of these numbers, despite the positive print today.
All right. Do we have an assistant joining joining the stream? If
We
so,
do indeed.
that's most excellent. Your assistant arrived just in time for a screen share of the Manheim Index versus the CPI used vehicle index. I did just want to put this up on the screen because we were talking earlier in the conversation about some of the conceptual differences. But you can see from a big picture standpoint, these things are largely trending in similar directions with
Yeah.
a bit of a lag, and so you can see then why the Manheim continues to be an important gauge to watch going forward. Um, I did just want to tee off something that you said, Catherine, just about the state of the economy. If we're here to talk about inflation, the one thing that could change the conversation in a heartbeat is this notion that maybe we're going into a recession. I personally don't think that is likely in the immediate term, given what we've gotten in the data recently. But there are a number of high-profile economists on the street who still think it's possible in Q3 and even likely in Q4. Jonathan, I wanted to ask you with the auto sector being sort of the weather vane that it often is. What are you seeing in your space that would suggest, an outright collapse or a lack thereof in the broader economy and consumer demand?
No, I certainly am in the camp that where the glass is half full, and I believe that recession odds are declining. I think we've got a resilient consumer. Yes, there are challenges in terms of affordability in auto and in housing that puts a cap on what's possible. But we're seeing no evidence of further declining momentum. Key phrase I keep repeating with almost every data point I see is we know definitively it is not getting worse. And in many cases, we're starting to see actually demand improve. Used retail got better at the end of June, and so far in July appears to be continuing to improve. And that's really been the weakest part of the market, and one where affordability and pressures on lower credit and lower income consumers has been substantial. And with these inflation numbers coming down, that means, as we mentioned earlier, real wages are real positive again, and income is positive again. And if the consumer's been resilient, and we continue to have a little bit of a buffer from pandemic savings, that bodes well for auto demand continuing to recover as the supply recovers.
Okay, and what about on the delinquencies side? There's been sort of much hand-wringing about the rise in delinquencies coming from the auto space.
Yeah.
How do you fit that into your broader narrative about the economy at this point?
Well, it fits that we have constraints on demand because credit is tight and will likely remain tight as well as rates remain high and not likely to come down in the short term. I think delinquencies are more a product of inflation than any sort of problems in the economy. So I'm expecting delinquencies to improve as inflation's coming down and incomes are seeing positive growth again from a real inflation adjusted perspective.
Hmm. And lastly, on that point, is there is there a moment that you look at as sort of the cutoff point where you say, geez, if financing costs don't start to ease by X date, I think that some of this resiliency in the auto space will go away, or is that nowhere on the horizon at this point?
I think we are starting to see some of the pent-up demand in new become exhausted, but you still have I mean, the biggest decline in the new vehicle market has actually been sales into fleets, and we likely have another 1 million to 2 million to go there. So we've still got room, and as evidence of that, if you look at the day supply number for a new vehicle supply, it has gone sideways all year, and it's still about 40% below what is likely to be the long-term normal. So that's proof that dealers are selling the vehicles as they receive them, and we're not having a growth in supply. And by the way, used supply is down year over year and very tight. So we see zero evidence of a lack of demand.
Hmm. Fascinating. Catherine, how do you fit recession probabilities into your story at this point? Of course, earlier in the year, people would often bemoan this notion that bond and rates markets weren't believing the Fed. Of course, it always felt like that was a bit of an oversimplification, and what was really happening was that fixed income markets were pricing a certain probability, call it 40% or something, of a downturn. Have your subjective probabilities of a downturn, at least in 2023, changed?
It's very unlikely that we have an economic contraction this year, especially with the labor market where it is. I like to keep it simple, and as Jonathan Smoke mentioned, real wages turning positive are a huge boon for the U.S. consumer, and it's such a relief now that you can actually get a car, right, Jonathan? I remember back in the COVID days, waiting more than 1 year to get a car in one instance. And as you heard, I have my little assistants. With 5 children, I need a big SUV. So to get the SUV, we had to drive all the way up to North Carolina because they were so hard to get. So thank goodness the goods shortage has been removed. I do think that we're still working with some post-pandemic repercussions in both economic and inflation data. So we need to take that into consideration. These still remain unusual times. So I would say that while the labor market remains this strong and this tight, while inflation expectations so well anchored, inflation is not imminent. It's not on the near term horizon. But we have to remember that economic cycles are that. We are going to get a downdraft. The question, of course, is when. Now, most strategists and economists, we've gotten it wrong. Year to date, we've seen remarkable consumption, remarkable service demand. The U.S. economy has been so resilient, 500 and likely 525, maybe 550 basis points in rate hikes over the course of 1 year really hasn't fed into the real economy to the extent and with the velocity that many of us had anticipated. That doesn't mean, however, and we have to avoid this trend bias, that it's not going to happen. So what I'm looking for, forward looking, rather than trying to extrapolate what's happening today and say what's happening today is going to be what happens for the foreseeable future, I'm looking at leading indicators to help me determine, help my clients determine how soon that rollover can occur. And one of the things that I look at, not only real wages, but also tightening of lending standards. And for this, I wanted to ask our resident expert, Jonathan Smoke, with regard to the tightening of lending standards. If you look at the Bloomberg, and I know you do not have access right now, Jonathan, but if you look at the Bloomberg net percentage of respondents tightening standards on consumer loans for new and used cars, it has in fact surged. And we're seeing let's call it 28% of
Yep.
respondents are saying that they are tightening lending standards. And you've seen this as well in financial conditions. So you're getting the aftermath of, it's famous long and variable lags, 12 to 18 months of impact on the real economy. We've had 12 months of 500 basis points of rate hikes. At what point do you see this impact to some extent delinquencies? We have not yet seen this in a meaningful way in consumer delinquencies or even housing delinquencies. We haven't even seen this in triple C bonds having difficulty with repayment of their debt obligations. My point here is that given the cyclicality and the inevitability of recession, after 500 and maybe 50 basis points of hikes, at what point in timing is difficult? Do we expect to see this rollover? I don't think that we can say there is no landing here. Soft landing could be defined as a small contraction. But my point here is, at what point can we expect to see the impact on the real economy of this magnitude of rate hikes? Given that we've seen tightening standards surge for car loans, tightening standards surge for consumer lending, surge for housing, et cetera.
Well, I would say on the auto side, we produce a monthly series on credit indices that's a bit more timely than what the Fed puts out quarterly. And what we see in the data is that credit tightened substantially last year, and especially in March and April, and again in May when we were working through the banking crisis. But guess what? In June, credit availability improved. So it fits my theme. It's not getting worse. I totally agree with you that what the Fed did last year dramatically impacted the auto market in real time. But I actually think we hit our turning point and the bottom really in the second quarter of this year.
Hmm.
Can I
All right.
ask another question, John, if you'd be so kind? Um, how about have you seen any signs of softening of demand of electric vehicles, Jonathan, given gas cars versus gas cars as prices have come down so precipitously?
So in terms of sales growth, we're seeing dramatic sales increases, but that's almost inevitable because of supply. This is the year that we really broke through with more traditional brands, almost every brand having at least one EV or one in the pipeline coming out. So big gains year over year in sales and in share of the market in the new vehicle market. But to my earlier point that days supply has gone sideways, meaning as proof that as inventories and deliveries have grown, sales have kept pace with it. The one pocket where that is not true is electric vehicles. Electric vehicle supply has been growing, which is an indication we're at an inflection point that the supply is exceeding the current pace of absorption and demand. I don't think that this is a long-term problem other than a view of reality that we've got to convince more consumers. We've been selling to the choir, to use a church analogy, and we're going to have to start selling to the average American, going forward, and that's going to require some discounting, some incentives. We see that too in the data as the supply is building up. So I think the EV market is going through a little bit of kind of labor pains as the market transitions, but that is the one area to pay attention to. That, by the way, also will help diminish the inflation impact because otherwise we still have batteries not at a price parity point with combustion engines. So if they weren't being discounted and heavily incentivized, they would be contributing to inflation as their share grows. But the opposite, I think, is going to happen in order to get people to buy them.
Fascinating. Good questions, Kathryn. Uh, I did want to put a bow on this. To wrap up here, what we're looking at is essentially a very good print. Somewhat expected, though it came in at the better end of expectations. I put the 2-year a Treasury note yield up on the screen just to give you all a sense of how the market reacted right when this came out, and you get the sort of reflexive massive leg down, which has been inching back up as we've had this conversation. But you can still say that the report triggered something like a 6-7 basis point drop in sort of the market's Fed expectations. At the same time, this is just one report. That's what Jay Powell always tells us. Going forward, the favorable base effects that Kathryn was talking about at the going to help us quite as much. Some of the methodological quirks in the index that have helped us in recent months, including health insurance, could start to go the other way in October. And so the question that I would love to leave everybody with for you two is simply, does a print like this change your outlook in any meaningful way? First blush, obviously. I've monopolized your time, and I know neither of you have had a ton of time to look under the hood here, but do you think that this will change your outlook?
It's not
J-
changing. It's not changing mine. I actually think there are more deflationary trends ahead for the auto components, and I think we're back to that story that the market is returning to balance and it becomes a bit more predictable. which I think is good for avoiding recession and keeping the auto market slowly moving in the right direction.
Okay, so not changing your story, but you went in as a glass half full kind of economist, and you're going out as a glass half full kind of economist. Fair to
That's
say.
right.
All right, Kathryn, what about you? Any change for the better here?
I think it depends on how much the Fed is serious about getting and how quickly they are serious about getting to that 2% target, John, because it's the hard part is not getting from 9 to 4, but 4 to 2. Looking ahead, I would say that we should expect headline inflation to reaccelerate over the course of July and August. My numbers are about 3.5% on average for the next two prints, and then probably settle closer to 3.2% by year end. A core CPI, so probably around that 3% range. So really a positive trajectory. Core CPI should also moderate, but finish this year above 4%. So this number itself, we can't discard as a complete anomaly or fluke. But we do have to realize the importance of base effects. So my point, John, is from going out from now, we can't just consider base effects anymore. It's going to come down to service sector inflation. And my view is that for the Fed to get to a 2% core PCE target, which is their target, it's a dual mandate, 2% average, full employment. We have full employment. We have near record low unemployment. The level of unemployment is inconsistent with that 2% target. So in my view, the Fed has to break something here to get to that 2% target, unless it is willing and able to maintain its inflation fighting credibility by withstanding a above target inflation print for an extended period of time. All this to say, I think 2024, the Fed keeps rates high at 525, 550 until getting to that 2% core PCE inflation target. I do not think that they cut, and I do not think that they change the target before reaching it.
All right. Well, I'll let that be the last word. Thank you very much to Jonathan Smoke from Cox Automotive and Kathryn Rooney Vera from StoneX. My name is Jonathan Levin with Bloomberg Opinion, and thank you for being with us.